In this video, we're going to talk about the argument for not using a stop loss. Stay tuned. Hey traders, a very warm welcome to you. Okay, so we probably know by now, if you're watching this video, that stop losses are very, very useful for risk management. We talk about the best way to place them, how far away they should be, how we structure them, etc, etc, etc. We go into a lot of detail as traders defining a stop loss criteria and position. But what about flipping that on its head, and let's look at this objectively and say, hey, what is the argument for not using a stop loss at all? Now, am I recommending this? Not necessarily, but I'm just putting it out there, and hopefully we can kind of build a discussion around this and say, hey, is this something that we should consider? Is it something that plays part of your trading or not? Or is there too much risk involved in it? Anyway, look at these points. The first one, the big one, is the probability of touch. What do I mean by that? In the options market, you've got the probability of touch and the probability of close. Two different things. The probability of touch is twice the probability of close. What do I mean by that? So let's say you have a price level of 100 and the probability of it touching that is, I don't know, let's say 50%. Okay, I'm just pulling this off the top of my head. The probability that it closes below, or let's say above 100, okay, which will be stop out. So if you're short and you've got to stop at 100, the probability that it touches that will be 50%. Fine, once it touches that, if it pings it, you're out. If you're using a traditional stop, the probability of it closing above that is actually half at 25%. So you can see already probably that if you trade with a stop loss, you're working against yourself with the maths. So you're basically saying, okay, as soon as it touches that, I'm out, and that's the highest probability. Whereas if you said to yourself, okay, I've got to see a close above it, the probability is now half this. Now, of course, it could close at 99.9 or it could close at 100.1. It's very strict, this, and of course, it could go on and on and on and on, but this is something to be aware of. You know, the markets will probe levels, they'll come back, they'll probe levels, come back. You've seen it yourself, you've probably been on the wrong side of it yourself, hopefully been on the right side of it a few times as well. But the maths behind it is saying, okay, we might hit a level, but that's twice as likely as us closing above that level. And so if we're just, as soon as we hit a level, we're banking that loss, maybe we're putting ourselves on the wrong side of the maths side of it. Of course, we've got to look at the other things that could go on and on, but maybe that's something to consider. Okay, number two, markets go stop hunting. Just pretty much as we mentioned there, and we can't talk about this without thinking about this, markets do go stop hunting. You know, there's a general liquidity hunt in the markets. Now, I don't subscribe to the fact that there's a cartel of people driving things, you know, to purposely to look for stops. I do know that in the pit, floor traders would look for stops. They would have an idea where stops were and try and drive markets towards those levels to get that liquidity. I also know that algorithms do hunt for liquidity, and it kind of makes sense that if you're looking for liquidity and you know that there might be some liquidity above this level, maybe you will kind of do some buying, see what happens when you hit that level. If there's a flurry of buy stops in it, maybe you can sell all that plus more and get your short position to the downside. Does that happen? Who knows? But we do know that just visually from a chart, we can see very often wicks above levels, wicks below levels, you know, things that would stop you out if you had your stop in a traditional point. So there's something to be said for saying, well, the market often does this, so why put myself at the mercy of it and just not use a stop at all? Okay, number three, you can never be perfect. This is a great way of looking at the market. You know, often there's an argument to say we can't be perfect with our entry. We can't get it right every time. So to go in and use a finite stop is being too ambitious. We're going to have to maybe scale in, scale out, work around the position, buy some more, close some off, buy some more, close some off. When it starts going our way, do we buy some more? You know, it's a constant rotation of in and out, adding to the position, pulling it back again, adding to the position. Maybe it's a lot more dynamic than just in, stop loss, out. There's something to be said for that, and I do know traders who are very, very effective at managing that. Okay, number four, you can control risk with size. So maybe you don't need a stop because you're trading such small size that you can stomach, you know, massive move against you, and you can just manage the position accordingly. You can kind of take a view on it and look at it and say, hey, it's gone against me loads, I'm going to cut it, or this and that, the other. So you know, there's something to be said for that. If no one position is going to damage you regardless of the worst case scenario, then perhaps you don't need a stop. If you still believe you want to be in the trade, then there is an argument there to say, hey, I don't need a stop. Many pros don't use stops. You know, there's a lot of guys out there who are trading without stops. You know, are the hedge funds using stops? Are they got an order in? No, they haven't. Have they got a point where they reassess and say, hey, you know what, we need to review this position. Is it doing what we said it was going to do? No, it's not. Do we still want it? No, we don't. Okay, let's unwind it. Or do we still want it? Yes, we do. Shall we add more to it? No or yes. So they're always reevaluating as opposed to having stops. And that's the alternative you've got. The alternative you've got is to say, okay, rather than a finite stop loss, it's to say to yourself, okay, well, actually, I'll have a reevaluate point. There's a point where I'll look at what's going on. But of course, the downside of that is, you know, if you're very sensitive to market moves, so you're trading with leverage and you're really kind of geared up and it rips off when you haven't got a stop, it could blow you up. So this is why, you know, most people will use stop losses. But if you're kind of got a reasonable position size and you can tolerate the occasional extreme move against you and it's not going to kill you, then perhaps there's an argument to say, hey, at this point, when my trade thesis is negated and it does not doing what I expected it to do, I'm going to reevaluate and I'm either going to decide to stay in it, cut it, minimize it, add to it, or whatever it may be, and make a decision from there, as opposed to just actually just pulling the plug on it without any thought for any other information. So there you go, guys. There's kind of 5 reasons, arguments, should I say, for not using a stop. Let me know your thoughts on that in the comment section below. I'll be interested to hear. Obviously, most people talk about, you know, how we should always use stops, and you know, I think that's a great idea. But I also think we should open our minds a little bit and think as other strategies, even though this can be very high risk. Is there ways of mitigating this risk? Are there ways of using this unusual way of approaching? As long as we have the risk managed some way and we're prepared to accept the risk that comes with a different strategy, the whole game is risky. Maybe there's something to be said from using this approach. All right, guys, thumbs up if you like this kind of stuff. See you in the next one. Take care. Goodbye.